Let's understand what dividends are and how they work. For this we have our friends Peter and Albert who have a market company. When they make the balance sheet of the company, and they have a solid enough profit, let's say about 500,000 euros, they decide to reinvest 200,000 in the company, and distribute the remaining 300,000 among the shareholders of the company. This is what we will call dividend distribution. Then, depending on the percentage of participation of each person in the company, they would receive the dividends, so we understand that dividends are nothing more than a part of the value of the profits of a company that is distributed among its shareholders. If Peter has 30% of the company, he gets about 90,000 euros, while Albert, who has 20%, gets 60,000 euros. The rest of the shareholders among those who would share the remaining 50%, about 150,000 euros, among the 10,000 shares that exist in the stock exchange. For each share that an investor has, he would earn about 15 euros. If the shares are trading at a value of about 200 euros, the dividend yield of the company's shares would be 7.5% per share. To calculate this percent we would only have to divide the share price by the dividend and we would obtain this number. We already know basically what dividends are, now let's see a little more of the real world. In the Spanish stock market, or better known as the IBEX 35, most companies distribute dividends. What happens with this? Neither the companies are obliged to distribute dividends, nor all those that distribute them do it equally. With shares we can earn money in two ways, through dividends, or through its capitalization, that is to say that the value of the company grows and with it the value of its shares. What happens is that the more dividends a company distributes, the less capital it has left to invest, which does not favor its capitalization. It is like a balance: more dividends, less revaluation, and less dividends, more revaluation. In the IBEX, companies tend to distribute dividends half-yearly or quarterly. For example, we see that Enaga's this 2024 has a dividend yield per share of approximately 11.5%. This means that if we invested about 10,000 euros in this company, at the end of the year we would have been paid about 1,150 euros in 12 months, which would be about 96 euros per month. Another way in which some companies could pay us are the scrip dividends, which would be the payment of dividends in shares, so to earn money you would have to sell them. Personally I do not like this, since to pay in shares two things can happen: or the big partners of the company deliver part of their shares, or simply have to issue more shares, which would cause the same effect as inflation, being the capitalization the same, the shares what they do is to devalue. This can happen for various reasons, such as the company's lack of liquidity, but in any case it is not to my liking. IBEX companies are characterized by paying a lot of dividends, but not for their growth. Many are part of very cyclical markets such as banks and energy, so you should evaluate many things before investing in them. If we compare them with SP 500 companies, such as Coca-Cola, we can see that this company pays much less dividends, but not at all pays little compared to other companies in its index, but maintains a sustained growth. Despite this, we can compare the graphs, Coca-Cola against Telefonica or Enaga's itself. You see the difference. Despite being lower these dividends, they have been increasing for more than 40 years, which makes the company a very safe and attractive investment for investors for their commitment to them. Therefore, it is not advisable to invest in a stock only for its dividends, since they can also stop paying them, this being a decision of the company's board of directors. You have to take into account the payment of taxes. In Spain, for example, it has a withholding tax of 19% up to 6,000 euros, 21% from 600 to 50,000 euros, 23% from 50,000 to 200,000, 27% between 200 and 300,000 euros, and 28% from more than 300,000 euros. If you reside in Spain but your shares are foreign, you may be taxed on dividends twice. For this it is important that you find out about tax policies. For example, there is an agreement between Spain and the United States to avoid this double counting. Another point to keep in mind is that you will not receive dividends from a company if you bought its shares 1 or 2 days before, which is done in order to avoid speculation in the markets. If you liked the video, do not forget to subscribe and leave us a like.